Whether you're new to investing or you know your way around the market, everyone needs a good investment portfolio in order to know where their money is going and how well it's performing. You can decide to put your money in the stock market, or you can choose to make your money work in different environments too. While there is no true way to diversify your money, there are some that work better for others and some that don't. This is Intelligentsia, real-life advice for practical and financial goals. Today, we want to talk about the pros and cons of the three most popular portfolio styles, and we want to compare how they would work for you. So let's get to it. When you invest your money into assets, you'd want to be able to get your money back. That said, depending on the asset that you've invested in, you can expect different things. If you'd like to make money and maximize your opportunities, well, the stock market is your friend. If you prefer security and being able to recur your money over time, then perhaps you'd prefer bonds. But there's no rule that states that you can only stick to one type of asset. While you may have preferences, it's almost always advisable to try your hand at most assets that you have access to in order to protect yourself the most. Generally, your portfolio should have access to different kinds of assets, but if you're someone that believes your portfolio is diversified enough with stocks, then perhaps the one fund portfolio strategy is for you. A portfolio is pretty much just a collection of funds that investors use to achieve their financial goals while mitigating risk. If it happens that the stock market is in a good place and you've invested all your money into it, then you'll be able to maximize your profits here as a result. The number of funds in a portfolio can vary based on the investor's strategy and preferences, with some investors heavily preferring stocks over other assets. A one-fund portfolio, as the name suggests, comprises a single investment fund. This could be a diversified fund like a total market index fund or a target date retirement fund. The advantages from this fund are as follows. Number 1. Simplicity. Managing and monitoring a single fund is easy and requires less time and effort. Considering you only have one asset in this fund, you don't have to worry about other markets as a result. Number 2. Diversification. Many funds, especially index funds, are diversified across a broad range of asset classes, providing a level of diversification within one fund. Some investors feel that having only one fund is fine, as it's already spread across multiple sectors, and as a result, your money is working everywhere. Number 3. Easy to rebalance. Since it's a single fund, rebalancing the portfolio to maintain desired asset allocations is pretty much straightforward. It's also a lot easier to maintain and make changes if you find that one specific stock has potential to perform well, and if some stocks are outperforming others. Here are some disadvantages. Number 1. Lack of customization. Well, investors have limited control over the specific asset allocation and sectors within their portfolio. Because you only have one type of asset in this fund, you can have control over stocks instead of having the security from bonds or any other benefits you may be able to get from multi-fund portfolio styles. And number 2, limited flexibility. It might not be suitable for investors with specific risk tolerance or investment objectives that are not met by the single fund. If you're someone that likes passive investing, you may be missing out on potentially better assets for you like bonds, REITs, or many others that can give you income over time. Overall, if you're someone that's knowledgeable about the stock market and you know that your investments are diversified enough to feel comfortable in your investments, then perhaps the one fund portfolio is good enough for you. Generally, it's favorable towards those who want to maximize their earnings through the stock market, instead of the slower, more secure investments through bonds and some others. If the market performs well and you have all your money in it, you would be making much more as opposed to someone who has their options more spaced out. Well, compared to the one fund portfolio option, you may find that the two fund portfolio to be much more secure and reliable in terms of protecting your money. You have to understand that when you invest in the stock market, you expect to make returns on your initial investment, and you gain money through dividends or capital gains. This is where you make the majority of your wealth if you play it right, and as a result, the one fund portfolio is an attractive option. However, it lacks the security provided by the two fund portfolio because of the lack of investment in bonds or some other secure assets that isn't directly related to the stock market. Just to clarify why, a two-fund portfolio consists of two different funds. usually representing different asset classes like stocks and bonds. Common combinations include a stock fund and a bond fund. Because of that, you have the security of bond investments and the income potential of the stock market. The advantages of having a two-fund portfolio are as follows. Number 1. Simplicity with diversification. More diversification compared to a one-fund portfolio while still maintaining simplicity. Because you're only adding one asset of your choice, you have the option of still having the ease of management. If you're someone that decides to invest in bonds as your second fund, then you have the security that comes with investing in bonds and the income potential from stocks too. Number 2. Customization. Investors can tailor their asset allocation to better suit their risk tolerance and financial goals. While this type of portfolio has more security, you're still allowed great returns because you have access to the stock market. Since your investments are backed up by your bonds, you have much more breathing room when it comes to risk, and you're allowed to customize your portfolio in order to accommodate more risk for better rewards. And number 3. Potential for higher returns. Combining assets with different risk-return profiles can potentially enhance returns compared to a single asset class. Because you have two different asset classes that aren't correlated whatsoever, you have the opportunity to get returns on both ends as a result. Now, here are some disadvantages. 1. There's still limited diversification. Compared to a more diverse portfolio, a two-fund portfolio may have limited exposure to other asset classes like real estate or international markets. Because you'd want your focus on just two assets, you're missing out on some potentially bigger markets that you can invest in. While it is easier to manage and easier to keep track of, there's also the risk that you're not diversified enough when both investments fail. Number 2. Asset allocation challenges. Deciding on the right allocation between the two funds can be challenging and requires careful consideration of individual goals and risk tolerance. Because you have two options, you have the problem of deciding whether you prefer maximizing your gains or if you're someone that wants to protect your wealth while it grows slow but steady. Overall, the two-fund strategy is popular because it has the best of both worlds, but at the same time, it could still have more assets and be more diversified as a result. Still, the risk of over-diversification is always a problem. That's why some prefer two-fund portfolios over three-fund portfolios or more. Generally, you'd benefit from this portfolio style if you're someone that likes to have a backup if one market fails, and you'd feel more comfortable taking on more risk if you have more assets elsewhere. Some people don't stop at two-fund portfolios, however, and instead opt for three-fund portfolios. This style also incorporates the use of international stocks. Because the economies in other countries are often different, you have the benefit of diversifying in another market that may be potentially better in terms of maximizing profit. Some examples of the advantages you may have from this are: Number 1. Diversification. Because you're exposed to a whole new market when you trade stocks overseas, you're allowed to grow more and you're not limited to the market in your own country. You're not limited to just stocks, you can also purchase any other asset that may be of use to you as a result. As great as that is, however, the disadvantages to this are lack of specialization. Because you're spread thin across 3 different types of funds, you may not be paying proper attention to sectors that could be providing you better returns. This fund also requires you to monitor it more due to the number of assets included in this type of portfolio. Generally, what you'd expect from this is that you've diversified, but since you're spread thin, you have the benefit of security, but the disadvantage of having to pay attention to different assets as a result. Maintaining this type of fund often requires more work than the previous two. Regardless of whichever fund you may choose, it ultimately depends on the investor's risk tolerance, knowledge, and financial goals. You also need to consider your investment horizon when it comes to these types of investment in order to make the most out of your assets. If you enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.